It's great to see you here. So we certainly see this risk on sentiment back in the market ever since the Fed cut by 50 basis points, or even really before that. Is there enough to believe that some of this momentum that we've seen in the latter half of the week is enough to continue?
Yeah, I mean, right now it looks like the soft landing scenario is very much still in the cards. And you're seeing that reflected in a lot of optimism across markets. We're watching, in particular, small cap equities, seeing, I think it's 6 straight days of gains, leading markets higher. Riskier assets are really celebrating this idea that the Fed can stave off a hard landing, prevent a contraction from happening, do it proactively before we see more weakness here in the labor market.
And so where would that early kind of evidence of weakness really begin to transpire from your perspective and what you're watching within the labor data that we've been continuing to track here, because unemployment right now is still sitting at about 4.2%?
Yeah, I mean, there's really 3 key things that we're watching, Brad, to look for signs that a soft landing can be achieved. The first one is that you need to see no real further cracks in the labor market. We look at things like initial jobless claims as being one of the most timely reads of the labor market on Thursday mornings, and those are still sitting in the very low 200,000s. I think any increase there above, say, 300,000 would be a bit of cause for concern. We're also watching credit market conditions. So right now, for lower quality players, borrowing costs are low. High yield bonds are now yielding just over 7%. That's the lowest level since 2022. If you do start to see more concern among investors that maybe a contraction is going to take place, you're likely going to see high yield bond spreads widen, which could cause broader issues from the market for a volatility perspective. And then the final thing is the Fed actually has to deliver on what the bond market is pricing in. So markets are pricing in significant cuts to the tune of another 50 basis points this year, another 100 basis points next year. Bond market pretty much in line with what the Fed dot plot told us. But if the Fed doesn't cut by that much, in essence, they're tightening, which could create tighter financial conditions and also challenge markets here. But so far, so good. None of those 3 things are happening. And I think you could continue to see some momentum here across risk assets.
Emily, let's talk about some of that momentum, because small caps certainly have been an outperformer here so far this quarter. When you talk about the fact that the Fed has begun its rate cutting cycle, what does that tell us just about further upside that we could potentially see, or is much of that already priced in?
I think, Seana, a lot of it's priced in. And I think, when you look at the outperformance of small caps, they're up 8-9%. Quarter to date, while the S&P 500 is up about 3%. So you're seeing some profit taking and large cap names and a rotation into small caps. We really see that as a sentiment driven rally. So you're seeing the riskiest parts of the market, the most cyclical areas, small caps really being a poster child for that, really taking off amidst this dovish turn from the Fed. But at the end of the day, there's not a lot of fundamental support for it. So of that 8% return this quarter, it's been entirely driven by multiple expansion, not earnings growth. In fact, in the second quarter, the S&P 500 saw double-digit positive earnings growth. Small cap equities saw 15% negative year-over-year earnings growth for the second quarter. And likewise, analysts are penciling in much more muted earnings growth for small caps going into the third quarter. So we would actually be fading the rally here in lower quality small caps. 45% of the Russell 2000 index is comprised of companies that don't make money. Their interest burdens are higher. We would wait to overweight small caps until an early cycle environment, and we're just not there yet.
So if the trade is to fade small caps at this juncture, is that just a reversion back into what's worked, which is megacaps, which is the AI thesis and all of the kind of picks and shovels around that trade that have been off into the races?
Yeah, I mean, we continue to overweight the quality factor. So these are companies with great balance sheets, tons of cash, good free cash flow, the ability to maintain margins in an environment where margins pressure is happening and playing out right now. So the poster child for high quality is going to be mega cap tech. So we've been there, but we have a little bit of a problem here as far as valuations go. In fact, the tech sector is bumping up on 30 times forward earnings. That's come down a little bit over the last several weeks, but still expensive. So what we want to do is rotate into quality at a reasonable price. We're finding that in areas like healthcare stocks on the value side, which are trading at a 10% discount to the broad market. And then another area that we're emphasizing are U.S. mid-cap stocks. Just think about the relative sector composition there. You're going to get a big overweight to industrials. Industrials right now are benefiting from a manufacturing renaissance that's happening in the United States, onshoring activity, fiscal spending around things like the CHIPS Act and the Infrastructure and Jobs Act. We're spending like crazy in the U.S., and a lot of it's being funneled into these projects, as you mentioned, pick and shovel type projects. So we're looking to play that more secular trend through through exposure to U.S. mid-caps and the industrial sector in particular.
Emily Roland, John Hancock Investment Management, Co-Chief Investment Strategist. Emily, always a pleasure to grab some time with you. Thanks for joining us ahead of the opening cross.
Thanks.